No. Get that off of there. I just spent 3 hours shoveling snow. I don't want to see it. A little bit extreme on the other side, but can we get a little picture of like a forest with a bit of greenery or whatever? Alright, that'll do. Look pretty sharp now, huh? Alright, so I'm here to teach you about investing, how to get profit and not lose money. So capture the upside, get out on the downside. But before we does it, get me a drink, because I need a bit of liquid courage. Oh, I'm not picky. Rum, whiskey, scotch, I don't care. Alright, what do you think I'm on diet? For sakes, I don't care anyway, I'll drink anything. A little bit of spiced rum. No ice cubes. Got any ice cubes? What kind of guests don't have ice cubes? For sakes. Get it away. Don't need ice cubes when you got snow. Oh, it's like a snowball in there. Best kind. Just like an ice cube. Alright, I'm gonna mix up this drink and I'll show you how to make money and not lose it like an idiot. Just wants a splash of the spiced rum. That good? I like the flavor. Lay that over there somewhere out the friggin' way. And he just needs a little splash of this for flavor. Maybe a bit more. Good enough. Alright, get that snow off it. I'll need more of that. Lots of snow out by the door. Now, I ain't stir it. Alright. Stir it up a little bit. Alright. Let's give her a shot. Give her a shot. Alright. Up, down, all around, touch the lips, slam her down. Oh, that's a strong one. Save some more for later. Alright, so what we're going to talk in this video. So, what we're going to talk about is just basic investing. Not going to get too much into the complicated stuff. This, the strategy I'm going to show you is a trading strategy, and you can teach it to your old 90-year-old grandmother who got dementia, don't know who the frig you are, and she probably could make money at it. So it is that easy. So follow along. Oh yeah, one more thing. If you don't like buying and selling, and you just like holding on to stocks, I'll show you how to use options so you can keep your stocks, and if the stock market goes, you can use a little bit of options to get insurance on your stocks so that you don't lose too much money. So, you know, you has insurance on your house, you has insurance on your car. If you got a business, you got insurance on it. But with options, you can have insurance on your stocks. If they starts going down, you buy a little bit of insurance. Guess what? Unlike businesses and houses and cars and everything else, you only got to buy the insurance when it goes down. Not every month, just when it goes down. So I'll show you how to do that. I'm also going to show you another option you can use for stocks as well, where you can just, it's almost like making your own dividend. It's called a cover call. I'll show you how to do that as well. But the way I'm going to show you, you're not just sticking a cover call on there and then the share price goes up and poof, your shares are gone. I'm going to show you how to pick the right time to write a cover call so it's less likely you're going to lose your shares. That makes sense? It's real simple. First things first though, have another drink. Ha. Ugh. Good stuff. So, alright, let's get back into it first. Let's get into it. Alright, so basically, you got a couple options. First, you can buy individual stocks, and guess what? If you buy as individual stocks, you runs a little bit more risk than on like an index or an ETF. And the reason for it, let's say you buy Tesla and Elon Musk decides he wants to get in a car accident. God forbid he do get in a car accident. But say if he got in a car accident and he gets hurt, well, guess what? Tesla stock's going to go pfft. And if that's all he owns, you're in trouble. So what I'm going to show you is index funds. Now, a lot of people have been pushing for using index funds, and there's been a bit of research out. So before we jump into how to trade, you're going to slap on this little thing. This is on CNBC, but you can find stats like this and even better ones all over the place. So basically, what it says here is if you look here, so basically active managers, so active fund managers trail the S&P 500, which basically means they have a lot of trouble beating the S&P 500. So over the span of the past 9 years, over the span of the last 9 years here, 64.49% of fund managers weren't able to beat the S&P 500. Now, if you look at 10 years, 85% couldn't beat the S&P 500. Is that not crazy? Even better, look at this. Over 15 years, 92% couldn't beat the S&P 500. Well, I'll tell you what, if you're real good at investing and you're better than these fund managers, good luck. But I doubt you can pick stocks as good as fund managers. So what I'm saying is basically using an index fund is probably your best way to go. And when I say index fund, you can actually buy the index if you got a lot of money. Index funds are expensive. So there are ETFs that charge a little tiny fee. The two most popular ones is all I'm going to talk about today. So I'm going to talk about the SPY stock, which covers the S&P 500. And then I'll talk about the NASDAQ. And then, of course, we'll stick those option stuff in there showing you if you don't want to buy and sell it, you can use it as a protection against downturns. And you can take a little bit of money as a make-believe or a homemade dividend, we'll call it. Anyways, so index funds, good way to go. Save you a lot of hassle. So basically with an index fund, you can just keep buying it, and over time, just look at this chart. If I zoom out and I keep going out and out and out, you notice how it keeps going up, 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 up. But there's always big dips like here and here. So my main goal is I try to focus on buying it and getting in on the low, riding it up to the top, getting out for this dip. So you see this big giant dip here? I prefer to be out on this, right? Let's look at the ruler here. Slap that on the top. If you bought the SPY at the top here and she tanked, you could potentially be down, what is that? Over 34%. Why not just be out? It's real simple, and I'm going to show you how to do it now. So there's one. What about another one? Let's run back another one. Another drop here. How much would it, if you bought at the top here and she dropped down, and right at the bottom, if you sold at the bottom, it's almost 20%, right? Just be out on that crappy time and get in on the good. You don't want to be that guy who's at the party when everybody's gone home and the owner don't want you around anymore. Well, that's basically what's happening. You stick in here and nobody wants you around, and guess what? You're going to run into trouble. So I'm going to show you how to trade, and I'm going to show you how to use the options for that as well. I'm just going to zoom in here a little bit. So you see this big blue line I got here. This one here is the 50-day moving average. If I double click on it, 52. Fairly simple. So it's just a basic, simple moving average. You can do exponential. You can do whatever you want. I don't really care. Do what you want. But I use 52. I like that little offset. Majority of people uses 50. The little offset just stops my trigger from getting triggered so much. So that's why I use it. But you don't have to do it. 50 is what everyone else uses. Do what they do. Do what I do. Do what you want to do. Up to yourself. I'm not a financial advisor or anything. I'm just some idiot on the internet. So take this all with a grain of salt. This is just all for education. So don't do any trades that I'm telling you to do, or you could lose all your money. Play it smart. Learn how to trade. Do your own thing. You know, common sense, right? Anyways, I'll use the 52. Very, very simple. Now, how do I do it? Let's say you got a bit of money coming in, done well on taxes, unlike the rest of us. I'm just going to zoom out a whole crap load here, so we can go back a bit, and then we'll start from there. So we'll have somewhere to start from. Just pick a point. So let's say we're right here. Where's this? This is I think it's 2019. Stick around there. So let's assume you got a bit of money. You're going to stick it in the stock market. Rather than just flicking it in there, here at the top, and there she goes in the toilet, minus 34%. How about no? How about you do this? Watch this. See that blue line? That's the 52-day moving average. I use a 52, you can use a 50. This thing only works because so many people use it. So when a share, like the S&P 500 or a stock, goes above the 52 or 50, or goes below it, a lot of people sees it, and a lot of people either buys or sells. Just follow the crowd. That's what they do. I follow the same thing. That's basically it. It's like I say, Granny Grizzle can frickin' learn how to trade. Anyways, look at this. So I want to pick a time when the share price, look at this. The share price, look, share price, right here, is below the 52-day moving average. Makes sense? Easy. Easy. Alright, let's zoom in. I'll show you exactly what I'm talking about. Look. I'm gonna look at it right here. So what I'm gonna do, I'm gonna set up an alert. So that way I can go to sleep. Not have to worry about it. Because I don't own the stock until when it's doing good. So I can go to sleep, go on a cruise, I can go on vacation, hang around with the kids, take the wife out to dinner. I don't have to be worrying, oh my God, what's going on in the stock market, because I got alerts on. So good to have alerts. So on TradeView, you can get all kinds of alerts. The free account, you get one. So if you want to do the free thing, you get one. Use it for the S&P 500, whatever you want to do. So, see the blue line? Click on it with the opposite mouse button. Click Add Alert. Stupid simple. This is the way I do it. I could be sleeping in my bed, nice and relaxed. Don't have to worry about losing money in the stock market. And then I get a ding on my phone to buy a share. Or a, S&P 500, NASDAQ, whatever. I buy it. It could be 2 months, 3 months, 4 months from now. I don't even have to look at it anymore. I'll get a ding to sell tomorrow, 2 months from now, probably not 2 years from now, but I'll get a ding to sell it, and then we'll look at it then to sell it. But I can just relax because I know that the alert's going to let me know when to get in and out, and I don't have to be an idiot sitting there and breaking my back, staring at a screen, burning eyeballs in my head. Why would I do that when I can just sit in an alert, play out with my kids, go on a vacation, take a cruise, do all the fun stuff, and not be staring at a friggin' screen all day waiting for a trade to happen. Not into that. I did the whole day trading thing. Too much hassle, too much work, and I can't handle the, doing all that work, and then you friggin' make a bad trade, and then you feel like crap for that whole day, and then you get a good one, and another good one, and then 2 bad ones. Not for me. I like this way. And you can do this if you want, or do whatever you want. Like I said, this is just education. Look at this. This one here, condition. Change that to SPY, SPY, or whatever stock you're trading. You want to get it for crossing. Now you can have it cross up and down, but why make it complicated? Just put crossing there. Unless you like being complicated, go for it. And then instead of value, you change that to the moving average we're using, 52 or 50 if that's what you're using. I'll talk about the 20 and the other ones after. Don't want it too complicated. 52 is all you need to know. Slap that on there. Select the date. Go out as far as you can. I would. Go out as far as you can. Remember, when that date goes by, your alert's going to disappear. So if you don't reset it, you're going to miss an opportunity. So pick a date in the future. How do you want to be notified? Well, if you got the app on your phone, ding on the phone. That's a good one. You can get an email. You can have a pop-up if you're sitting down to the computer. My favorite is the one on the bottom. Look at this. Send email to SMS. They'll send you a text message. Like, easy. Now, the only issue with stocks, the market's only open Monday to Friday. It's closed in the evening, so you can go to sleep and not have to worry about it. if you're trading crypto and you got an alert on, you could literally be asleep. China could be over there beating the crap out of Bitcoin and we don't even know. So you'll be asleep 3 o'clock in the morning, ding, phone goes off, stumble out of bed, make a trade. I mean, if you're trading crypto, that's the harsh part reality of being a crypto trader. But we'll look at that some other time. Right now we're talking about stocks. S&P 500, NASDAQ, all that good stuff. So, you're going to get a text message. See this part down here? Message. You're going to put boy, SPY. You get a text message, then you know it's time to buy. Simple enough. Alright, you click create. I already got one made, so I'm not going to do it. But click create, and then what happens? Like this here. You're not going to get a ding 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 for a couple days. No ding here. Now let's look at this one. So you see that red line goes up? You would have got a ding on that one. But here's the key goal with this strategy if you want to take this education and do it yourself, which I don't recommend, because if you don't know what you're doing, you can freak it up. Anyways, you're going to get a ding on your phone on this red candle that popped up above the 50. So what happens? It went up. Do you buy it right then and there? Frig no. When do you buy it? You wait till the end of the day, about 5 to 10 minutes before the market closes. And you walk in, you pop open your app on your phone or your computer, you have a look and you say, look, it's below the 50, so I'm not going to buy it. You only want to buy it when it closes above the 50. Make sense? So you buy it a few minutes before it closes when you know it's going to close above the 50. And why do we do that and not wait till the next day? Well, look here. You see this one here? Actually, that one don't show it. This one right here, look at that. It closed above the 50. If I bought it before, at the end of the day, when the market closed, now you can do after hours too, but we're not going to get into that. But if I bought it at the 50 here, when I got that ding and I knew the market was going to close, if I bought it here, I will own it right there. But if I waited till the next day, it's freaking up here. And that happens all the time. Let's go out. Look, open. You get your ding, you buy it here, and open here. If you wait till the next day, you're buying it up here. Anyway, same thing with for down too. Where are we to? Let's get back there. Alright, so this is basically what we got. So we get our ding, we don't buy it, it drops back down. Good thing we didn't buy it, right? And then what happens? It stays down. Look, it didn't close above the 50. Now here you go. Look, it closed above the 50, but you notice how it closed here, so I would have bought it right here. Make sense? Good. Hope so. And then, there we go. And then from here, so I would have bought it here when it closed above the 50, a few minutes before it closed. I would have bought it here. I let it run and run and run. Look, it tested the 50. It didn't go through. I'm going to wait till it closes below the 50. Come on, buy when it closes above the 50. Sell when it closes below the 50. Stupid easy. Come on, people. It's real easy. Look, so from here, I would have sold on this red candle here. Stick the ruler in. Buy. Sell. 8.7. What's that? 8.79%. Right? And what happened? It tanked. If you would have stayed in there, you would have gave up all of that profit and lost money. 31%. While other people are holding it, being the bag holder holding that turd, that big doggy turd in the bag, and crying at night, and the wife's mad at him, I'm sleeping good. Could be on a vacation. My money's sitting in cash. So, nice strategy. Give her a shot. When's the next time? Sets up another alert for the ding and let me know when to get in. Look here. So the 50-day moving average acts as support and resistance. So it didn't break through. It tried to break through, didn't break through. and then it closed up through here. Look, closed right here. Over the bottom, right at the top there. It ran up, tested a few times. Look, it tested right here. Tested again, and then where it closed below, right here. Slap that ruler on again. What about it here? Let it run up. Close below. Out. Ta-da! And that is, oh, that's a good one, 16.83%. And then you're right for that little bit of monkey business. You would have got back in. Now, here's the thing about this trade, this strategy. You're going to have a few little duds. The main part of the strategy, you have to cut your losses really quick. As in, don't let it keep dropping. Cut your losses really quick. Let the runners run, and use your 50-day moving average as your guide. So, like I said, right here, didn't go through. You got a few dings on your phone. Now this red one here actually closed above the 50. Then it closed below. So, as I told you, you're going to take a few losses. So a little tiny loss there. You probably would have got out here. You would have took a 1.67% loss. And then, of course, the next day, son of a pup, she closed up here. You would have got in. You would have got out again. You would have took another little tiny loss. And guess what? You would have got in here. You probably would have took another loss. That's 3 little losses in a row. Little losses, not big losses. Because you're cutting it, not letting it drop 30, 25% or whatever. So if you got in again, you would have took another loss. So you got in here, she ran up, come down. Closed below, you took a 0.5% loss on that one. And then of course you were out for this dip, which would have potentially have been as low as almost 5%. Almost 5%. You could have been down there if you would have stuck in it. And then of course you finally hit another runner. Look at that. So you would have bought here, you would have run it up. Look at that. It didn't close below, it closed right on it. So that would have set off your alert, but you probably wouldn't have sold it. I gotta zoom out a bit more. So it didn't go off here, and then you got another alert, but you didn't sell it. Another one, and then you would have got out here. So let's measure that one. Here, up, down, close, out, 9.5%. Come on, people. This stuff is so easy. You can teach a baby. You teach your 90-year-old grandmother who got dementia, don't know who the Jesus you are. It's so simple. Look, another one. I'm going to zoom out and not stop making it so complicated. Look. In, out, in. Actually, this one's in, out. Out for this crap. In, out. In, out, in, out. And then you would have been out for this big dip. If you would have been holding that big bag of turd from here down, you'd be down another 10%. Like, why not just be out on these times? It's real simple. That's the basic trading strategy. I'm going to show you how to do the same strategy with the NASDAQ using QQQ, which is an ETF people can afford. I'll show you QQQ, and then once we finish the QQQ trading part, we'll talk about the options and how options works. So you can keep holding onto it, not taking a big capital gain loss, and saving your butt in the event that it does drop like a rock. But we'll talk about that in a few minutes. I'm going to just slap on the Q's. QQQ. Ta-da! Stock, NASDAQ. So this is an ETF that tracks the NASDAQ. Do this strategy work with the NASDAQ? I don't know. Let's try it and see. So, before we jump in, why would I look at the NASDAQ and not the S&P 500? There's a good reason for it. The NASDAQ holds a lot of tech stocks, and tech has been on fire. And to be honest with you, it's probably going to continue to be on fire. You got robotics, electric vehicles, you got genome technology and all this other stuff coming out. Tech stocks are where the money is. So I'm just going to show you before we jump right into it. I'm going to click on this compare thing at the top. And I'm going to compare it to the SPY. So as you can see here, the S&P 500, most fund managers can't beat it. And in the last 15 years, I mean, if you were just buying the S&P 500 for the last 15 years, you would have beat over 90% of people managing money. I mean, it's common sense. But here's the kicker. Look at this. If you bought the NASDAQ, right now the S&P from, let's go with 2020. We'll slap 2020 here. So from 2020 up to 2022, the SPY is up. Was that 39, almost 40%, which is awesome. That's great. However, the NASDAQ is up 60, almost 70%, almost double it. So, like I say, if you just buy growth stocks, you could probably beat the S&P 500 and do better than most of the fund managers. Or just buy the NASDAQ and don't have to worry about the CEO of a company getting shot and losing all your money. Because if something happens to a CEO in a company and you own the Qs, that one company is not going to affect the NASDAQ that holds, what is it, 100 different companies? One company is not going to drag it down as much. But, yeah. Anyways, keep yourself protected, you know what I'm saying? Index funds is the way to go. But you can play around with other stocks and stuff as well. Just be a little bit more conscious that a bit more gamble. If you pick the right ones, you can do well. But like I say, if the fund managers can't pick them, what's the chance you're going to too? Before we go ahead, I'm going to just delete the S&P 500 off of here. And we're going to look at the trading strategy. Then we're going to talk about the options, which any investor should know. Let's just jump in here. Pick a spot. Look, it's below the 50. What am I going to do? I'm going to click on it with the opposite mouse button, and I'm going to set up an alert. For condition, I want to make sure it says QQQ or whatever stock you're doing. You want to make sure you have crossing here. Change that value to the moving average you're using. Of course, I'm using the 52, but you can use the 50. And then, like I say, I like the text message, so I click the bottom one, but it's completely up to yourself. And just put buy QQQQQQQQ. Buy it. Buy. Whatever you want to put there for let you know. Click on create. I already got one on this one, so I'm not going to stick another one on there. So, you put your alert on it, and guess what happened? For the next, was that 2, maybe 3 weeks? You're out driving on the Sea-Doo, having a good time, on a vacation, you know, or you're working, you know, got to do that stuff too. And then, one of these days down the road, ding! Buy. And what do? You come in and look at it. Do you buy it? No. When do you buy it? You wait till the end of the day. At the end of the day, so this is your one that went above the 50. You get your ding, boom. You wait till the end of the day. 5 to 10 minutes before is definitely going to be above the 50. So here's your buy spot. And then, of course, because it's above the 50 now, the 50 is going to act as support. And you can see it went up and came back down, but it didn't break below the 50. And it might go below the 50. Hopefully it don't stay below it. So you're in, got a little fake out. You probably would have got a ding on that one. Yeah, it did go a little, it did dip below a little tiny bit. So you would have got a ding, you would have reset your alert. Some people might have sold, they would have gotten nervous and got out, but then you would have got back in the next day anyway. So what would have happened? Ding, you're in, you would have followed it up, and then up here you got good. This one would have dinged off on your alert. You might have sold out here because it's right at just slightly below the line, but if you didn't get out then you would have got out here on that green one. So let's see what the profit is on the NASDAQ for this trade. That ruler on, slap that ruler on. You would have got in here, you would have been in the red for a little bit. Almost, what's that, 4%? Boo. Up, and out right here. Bloop. And there's roughly 27% profit. Come on, people, it's so simple. Just figure this stuff out. Don't do what I'm doing though. This is education. Learn what I'm doing and figure it out on your own. Anyways, and then of course you're out for this little bit. Let's just zoom out and start slapping some rulers on there. Let's see, out, you would have been in, you might have captured a little tiny bit of profit there. You would have been in for that one. Out, I'm just doing a rough estimate. That is another 12% profit. You would have been out for that bit, probably would have took a little bit of a loss on that one. You might have broke even on that one. Maybe in the minuses by a little bit. And then of course you finally caught another runner here up. What's that? Another 9%. Now you would have, actually I don't think that one went down, so probably would have been up here. Pretty good, what? And then you would have got another one here, up, down, out. You probably would have got out around there somewhere. You would have captured another 2.5%, probably took a little loss on that one. And then for this drop that is on right now, you would have been out for that. However, if you were holding that, gotta have a drink first. Up and down, all around, touch the lip, slam her down. Good stuff. So, if you were out here, you would have got out there, didn't go above the 50. You could have potentially been down as much as 12% on that one. Why not just be out and wait for the next one? All right, that's enough time about trading. The next one, we're going to talk about options. I'm not going to even show you on the S&P 500. I'm just going to do it right here and show you. So guess what? We're trading here. I'm going to go back a bit just to show you. Now, if you don't know what options are, it's basically a contract to sell your shares at a certain price or buy shares at a certain price. So put options gives you the right to sell the shares at a certain price. Call options gives you the right to buy shares at a certain price. So with that being said, you can be on both sides. I'm not going to get too complicated about this. I'm going to make it real simple. I'm just going to tell you, you got to do some research on it if you really want to figure it out. So if you're just one of those people who just wants to hold the S&P 500 forever, but you don't want to, you want to have some insurance on it so that when it tanks, you don't lose your shirt. You get to sleep at night, and if it keeps going down and down and down and down and down, you can still sell up here. Sell at the top. Because you got a contract saying you can. So there's your insurance. S&P goes, split. You can still sell at the top. That's what we're talking about here. So let's look at it. So you got into this trade. You let her run up. When will you put on this thing? Look at this. If you had a car or a business or a rental property, you would be buying insurance every friggin' month. Just throwing money out like that. Here, take all my money. All the profit I just made, I'm going to give it away. Frig that. Look at this. Just slap that ruler on. So you got in here, it ran up to here. I got to look at it. 1, 2. What is that? Do it say how many months it is? 1, 2, 3, 4. 5 months, and you didn't pay any insurance. Guess what? You paid a little bit of insurance after the 5-month period. So what do I mean by insurance? So when the share price drops down below your sell point, so if you're a trade and you would normally sell it, well, guess what? Instead of selling it, if you just wants to hold it, say if it was a dividend stock and you want to just keep getting dividends, you can do it this way too. So what do? You are going to go and buy a put option. Buy a put option. And what that will cost you, it depends on what stock you're trading. I'm not going to get into it and look at different brokers and stuff like that. If you got a broker, check it out. But S&P 5 or the SPY, you might pay like maybe $200 or $300 on 100 shares. So you might pay about 1, maybe 2% of your total investment for insurance for that month, which is not a whole lot. I mean, you're just protecting yourself. So what do? You put a put option on here instead of selling it. So you get to keep the shares in your account, and if it drops down by 30%, you can still sell it at the top. It's not that complicated. So you buy a put option. You can go out 1 week, 2 weeks, 3 weeks. I usually go out a month. Let her play out. So if you went out 30 days, so right here, if you went out 30 days and you paid, say, $200 for it, at this point here, it would have been up. And you basically just paid a little bit of insurance. The insurance money's gone, and you just wait it out. And then, of course, next time you might have to buy it again when it drops below to 50. But guess what? You might have had 2 months of paying for insurance on the NASDAQ. And then look here. You didn't have to pay no more insurance for another 4 months. So 2 months, 5 months no insurance. You pay for insurance for 2 months. You don't pay for insurance for another 4 months. Come on, people. If you're not using put options to protect yourself, you're nuts. You're nuts in the head. You got to get checked out. Come on. You got to learn how to use put options, for the love of God. Now, I was talking about put options. One more thing I'm going to talk about is covered calls. So the QQQ, I'm not sure how much of a dividend is the QQQ. I think it's 1, maybe 2%. So how about you make your own dividend? So here's the problem people run into. Now there is stocks that do covered calls on the NASDAQ and on S&P 500 and stuff, but the issue is they just keep writing them. And guess what? Your stock gets called away. They end up having to buy it back at a higher price, and ends up, you know, if the S&P or say the NASDAQ is going up like this, if you buy one of those ETFs that's doing that, it's not going to go up as good as the S&P, as the NASDAQ, because their shares are getting called away and they're ending up having to buy it back at a higher price. So this is just a little strategy. You're not going to get monthly dividends out of it or nothing like that, but you can just draw a little bit of money out every now and then. It works a little bit better with volatile stocks that trade really high, like Tesla and stuff, like the ARK ETF, or all of those ARK ETFs. But it works quite well for those. How do you write the cover call? All kinds of different options. Some people will use 2%. S&P 500, the 2% rule is okay, but when you got more volatile stuff like the NASDAQ or ARK Fund or Tesla or Nvidia or something like that, I wouldn't do 2%. If your broker offers options where you can see what we call probability of being in the money, you want to go with a probability of being in the money. What I use is either 20 to 30%. Now, if you don't have probability of being in the money, you can use delta, a 0.2 delta or 0.3 delta. So if the probability of being in the money is 20, that means there's 80% chance you get to keep your money. The delta and the probability of being in the money is roughly about the same. So if your delta or your probability of being in the money, you set it at 30, so that's the strike price you pick. There's about a 70% chance you get to keep your shares, which is no big deal. You pull a bit of money off, put it in your pocket. If it goes above, then you just do what the other people do. You can either sell your call, take a little tiny bit of that profit off, let my shares go and try to buy it back at a cheaper price. But anyways, like I say, I'll give you an example. What about if you write your cover call down here? Guess what? Your shares are definitely going to get taken away. A lot of people just write cover calls whenever they expire. So they're writing cover calls every month, and they always keep losing their shares. It's not so bad on the S&P 500 because it's not as volatile. But if you're writing cover calls at random spots on the NASDAQ, you're going to be always buying and selling them and losing some here and there. So if you're just going to buy and hold and you just want to take a little bit of money off the top, here's how you do it. You see this RSI, when you get a good spike in the RSI here, that's your best time to write a cover call. Because if the RSI is saying a stock is overbought and it's likely going to pull back a bit, you write a cover call here, it's less likely your shares are going to be taken away. And you're going to get that money in your pocket, and a month later, or 55 days, or whenever you want to do it, a month later, you keep the money, you keep the shares, and you wait for your next spike on your RSI. That's how I do it. What about if you didn't use the RSI? What about if it's down here? If you wrote a cover call down here, no matter what delta or what probability being the money you picked, you're going to lose your shares. You got to be pretty good with your math. So with that being said, I usually don't write cover calls every month. I just write them when I see a good spike in the RSI here and the share price is elevated. That's my favorite time for doing it. All right, we're going to talk about a few more moving averages before we finish up. Now up here, I have the 200, 100, and the 20. I'm just going to talk about the 20 first. So you click on the eyeball, 20 pops on. There we go. Doesn't happen on the NASDAQ too much. In more volatile stocks, this is when I would do this. So if you bought when it closed above the 50 and you rolled it up, now what happens is when I start seeing a big gap here, so assume none of this is going to happen. When I see a big spike on the RSI, and on stocks, I usually go with, if there's a gap between the price, and the 50-day moving average of more than 15, sometimes I'll go with 20. This one is 12, so it's not really enough, right, for this one. But if it's more than 15, what I'll usually do, because I don't want to lose all this potential profit here, I'll slap the 20 on as my exit point, and I'll use the 20 as my exit point. It works really good with crypto. Way better with crypto than this one, than NASDAQs and stable stocks. But if you slap the 20 on, so stick that light blue line on. So if you got in here, and you were getting out on a close below the 50, you would have got out with 27% profit. But if you switched on the 20 and used that instead, you would have locked in a bit of extra profit. So you would have got 36% profit. So you can lock in an extra bit of profit. And when you get crypto, I usually stick with crypto of a gap of more than 25 to 30%. So when the share price up here, so you stick your ruler on. So with crypto, if you see like 25% difference here, like you can literally, if it tanks, you can lose 25% of your profit. Yeah, 25 to 30%. I'd stick the 20 on and use that as my exit. So anyways, we're going to be making more videos about crypto and stuff, so you'll see those, the way to do it with crypto. So the 20 worked really good for that. Now with that being said, if you like trading more frequently, you can see here how the 20 acts as support and resistance as well. Support and resistance. So if you want to use the 20 as your trading strategy, you can. If you like trading a bit more, it's up to yourself. I'm just going to turn that one off. Now if you're really long term and you don't want to be frigging around with writing put options or trading in and out so often, like with the 50, you can just slap a 200 on there. And the 200 is a real good line that people use. So you can see, breaks above, you buy, and you would have held it for a very, 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 very long time with the 200. But the only issue is with the 200, you're going to get really big gaps. So if you're at the top here and it tanks from here down to the 200, you're going to lose with that 12%, right? So if you just want to be a holder forever, you can do the 200. But you want to try to buy it when it goes above the 200, which could potentially happen soon. You see this? Could potentially happen soon. Potentially. We'll say potentially. But if it closes above the 200, that's a good time to enter. You might get a good run. You see how it acts really good for support? Add support there, and when it broke below, as soon as it broke below, people were like, I'm out. And then it went in the toilet. So 200 is a good option if you just want to hold for a long time. And like I say, do you have to sell when it goes below the 200? No. You can do whatever you want, really, because I'm just teaching education. But if it goes below the 200, that'd be a good time to put on your put. Look at that. If you were using the put options for this one, the 200 here, look at that. How long did you go before you had to use insurance? From here, up, 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 up. Here, you went 448 days. I believe that's what it says there. No, that is 647 days. You went almost 2 years without having to pay a single bit of insurance. Try doing that with a rental property, or with a car, or with your house. Good luck. So yeah, if you want to use the 200, that's a good option as well. You can use a 100 too. That one works quite well for support and resistance as well. I use the 50. 50 and 200 are the ones that people use the most. So if other people use it, it's more likely to hold up for support and resistance. So that's the game. That's how you play it. If you just want to play around with it, guess what? TradingView got paper trading too. So you can play with fake money. Drink time. So don't go throw money in there like an idiot and just assume that you're going to do right. Play with some paper money for a month or two. The stock market's always up and down. It don't matter. You're not going to miss an opportunity. Opportunities are going to come and go for the rest of your life, forever. Why get nervous and say, I got to put money in right away? Play it safe. Be smart. If you like these videos, click that like. Click that subscribe. Click the bell icon. And guess what? You'll see more videos. Thanks for stopping by. Happy investing. Peace out.